Hello everyone, welcome back. Very good, last few coming in. Okay, so just before we start, that survey Jason mentioned, if you just want to scan that QR code, you can get it. If not, it is in your CGFI email. Some of you it managed not to go in the junk for, so you have a link. So welcome to section 2. We are going to be talking about some grand challenges this afternoon. Let me get PowerPoint number 1 out. So just before we start, can everyone please for me, if you identify as an early career professional or an early career scientist, just stand up. Someone start it off. There we go. And now just turn around a little bit. Do a little spin. Yeah. So everyone who's sitting down, your job at the networking drinks, when you've got some booze, is to make sure you talk to at least one of these people. Because if you want something done, you ask these people. Okay? Right. So now we can move on to our exciting session. So we got 3 talks today, and they've each got a theme. So we're going to be thinking about grand challenges from the past, present, and future perspectives. And then we'll have a panel where we bring in some clever academics to reflect on how we can all work on these problems together. So first up, Richard Dixon, over to you.
Hello, I'm Richard and I'm a late career professional. So like about 40% of this room, I did a PhD at Reading about 25 years ago, and since then I've mainly been a inquisitive nuisance in cat modelling and insurance industry, and hopefully some of these slides will give you an indication as to why. And I'm going to set it up. A lot of what I want to talk about I'm going to set up with this slide, which I've slightly bastardised, but it's from the IPCC. And in our industry, a lot of what we talk about in terms of the future is trying to get insurers to work out what their future risk is going to be in 2020, where they're just reading numbers off the chart there. The temperatures have gone from above the 1850 to 1900 levels. They've gone from 1.25 to 2 degrees. So, but one thing that bothers me is we're thinking a lot about 2050 and what's your view of risk for 2050. I'm bothered about the fact that in the last, well, again, reading off this chart, in the llast 60 years, the temperatures have already increased by 1 degree. And so the regulators ask us, do you understand what you think the risk or loss to your portfolio looks like in 2050? And I go, hang on a minute, can we be sure we're estimating the climate impacts for the present day correctly first? Get the present day right first, and then you can start thinking about the future, because our underwriters want to know what the price should be for the next year. And we'll probably hear that again in one of the other talks, just in terms of time horizons. Also me, the fact is we have 30 years worth of cat modelling expertise who've been building cat models, working out how the vulnerability has changed over time, how the exposure has changed over time. And we've got enough historical experience actually to understand how the risk and loss has changed in that time. So that's kind of what I'm talking about here, me thinking about the past, Cameron's talking about the present, and then Tom's talking about the future. I think that's the way how we've agreed to talk about it, I hope. So 3 things really here. How can we learn from history? Spotting trends, what's an appropriate historical hazard base, and then looking at shifts in risk and loss over time. So here's an example. This is a type of cat event that's happened in history from the last 85 or so years. And the question to the audience, you don't have to answer it, is there a trend in this data? Maybe it's increasing a little bit. And this is a different lot of cat data. Is there a trend in this data? Maybe it's increasing a little bit there. And what about this data set? It's probably increasing a bit, then dropping down again. The reality here is that I've completely lied, and this is just some synthetic data. But behind this, for each individual year, I've imposed, at the start of that period, there's a 25-year return period, so there's a 1 in 25 chance of an event happening. At the end, there's an 8-year return period. Now, if I told one of my underwriters there's a risk that appears like sort of probably 1 in 25, but it's now in 1 in 8, they'd probably go white and shout at me. My point is here, just using a very simple synthetic example, is that significant risk shifts, and this is like something going from 1 in 25 to 1 in 8, can be quite difficult to spot in historical data, which is part of the problems we've got in terms of working out what's changing now and how much of things changed in the past. And our industry writes insurance contracts anything from 5 or 10 years up to 250 years. If you're trying to find out what the 1 in 250 year risk is and how that's changed over time, that's pretty damn difficult when you're looking at an 80-year or 100-year data set. It's very easy to get fooled. We're seeing trends in historical data because there might be a few more events now or a few fewer events now in most recent history. And the return periods we want to understand, 1 in 100, 1 in 200, you probably need thousands of years of historical data or thousands of ensembles to do this. But that's kind of my plea at the end of this slide is just, can we have more ensemble climate model data to help complement what we're looking at in historical data? And I've got an example here. So this is just looking at typhoon data. So in that little yellow box there, where typically a lot of the typhoons move, all I've done here on this chart is show the average sea surface temperature from what's on the x-axis to the present day. So since 1950, the average SST in that box is 26.9 degrees. If you move to 2000, if you go from just 2000 to the present day, the average temperature in that box is actually 27.3. In the last 5 or so years, it's 27.7. So the historical sea surface temperature warms as we use less and less of history to work out what the average temperature is. So my basic point here is that if hurricanes are moving over this sea, is a 1950 to 2022 historical typhoon data set relevant to the present day? And we've been having a think about this at Inigo, myself and my colleague Ruth, who's sat over there. And this is in the eyes of a climate model that goes from 1950 to 2010. It's 100 ensembles. And effectively what we're trying to do, and again, this is probably a 20-minute talk in itself, is trying to fuse what we see in the climate model with what we see in a CAT model. And through that, we use the CAT model to adjust the CAT model and get some different results. And so effectively, when we look at the whole period, we fuse the climate model to the CAT model and we get some numbers out. But if we then start to trim the data, so we look at just at the storms that have occurred from 1980 onwards, we start to see that the average annual loss increases by 5% compared to if you just use the tracks from 1950 to 2010. If you look at 1990, the average annual loss goes up by 10%. Then we're starting to get a few too many tracks, and we're starting to run out of data effectively. But who knows what the AAL would be. So AAL is average annual loss. It's what you'd typically expect to lose in a year. And who knows what happens, if we were just to try and limit it to, if we had maybe 10,000 ensembles rather than 100, and we had enough data to be able to look at the most recent period. So we can see, and we're making adjustments in-house for this to allow for the fact that the model probably should be a little bit higher. And on top of this, we can also use the data to work out the natural variability, what the losses should look like in an average year when there's no El Nino and La Nina. And that's pretty damn noisy. That's plus or minus 20% over and above any climate delta that you've got. I know that Cameron's going to be talking about this in his bit, so I won't steal his thunder. And then one other thing I wanted to look at, which is a thought experiment. And I think in recent history, CAT modelling has got a bad rap in a sense that it's been levelled that it's not necessarily any good for climate change. But the fundamentals of a CAT model and how it's built we can use for whatever climate state. It's absolutely fine in my view, having worked at a CAT modelling company and then been an irritant to CAT modelling companies for the last 20 years. I can still see that it's perfectly usable. So what we've done really is effectively downgrade history, look backwards in time, again using the exposure model that's been built by the CAT modelling company, and then move forward in time to understand how the average annual loss has shifted since 1910. And in doing so, we're seeing how the vulnerability has changed over time, using the vulnerability that's been developed over the last 20, 30 years by the CAT modelling company, and then work out what's the impact of exposure, vulnerability, and hazard on a delta. Now, the hazard that there's arrows, demonstrate what's relevant to what. The hazard that we've used here is use the model's very basic standard view, so it uses all historical data back to 1900, but I've implied my own climate change delta, and that is using the work of Jim Cossin from a couple of years ago, where he spotted that a number of the percentage of the Cat 3s to 5s have increased over time. So I've just effectively, again, used the Cat model and made some adjustments to it, and the number of Cat 3s to 5s in the model go from 30% at the start in 1980, which is not too pretty close to what the Cat model has, to 40% in 2010. And that, you can see the risk is increasing. You know, the number of Cat 3s to 5s are going up by about 33% here. So this is what it looks like. If from 1910 onwards we just carried on building property as if it was 1910, so imagine lots of wooden shacks around the US, this is what the average annual loss would look like. And this is all driven entirely by population movement at the county level. So back in 1910, it's about 3 billion AL, and it goes up over time until 2020, we're at somewhere between 15 and 20 billion. If we then impose this climate delta, the Jim Cossin work, where there's a lot more Cat 3s, 4s and 5s, well, Cat 3s, 4s and 5s, they drive the loss full stop pretty much. So this increase of 33% in Cat 3s, 4s and 5s is driving an increase of about 25% in the average annual loss over time. But the Cat modelling company spent a lot of time to try and understand how building quality has improved over time, how building codes have been applied. Often after 1992 in Hurricane Andrew, building codes changed in Florida. So we can also take a look at we've got the climate delta going up. Now let's take off the impact of building. And you can see actually it drops down quite a bit. We're already adapting to this. And this is one way of showing it. Another way of showing it is to say, okay, if we look at the average annual loss from 1970, how much has it changed over time since then? What's the delta since 1970? And what are the constituent parts and how have they changed, which is what we're showing here. So since 1970, the population delta is going through the roof. The climate delta is still there. You know, it's significant, but it's not as big as the population delta. But you can also see how the building improvements delta is sort of kind of almost nullifying the impact of climate. And it could be partly why if you look at data, it's going to be quite difficult to spot climate deltas because there's human stuff going on, and it's not just populations moving, we're making buildings better. And this is being noted. This is a paper that was out earlier this year that said, stop blaming the climate for disasters. We must acknowledge the human-made components of both vulnerability and hazard, which I'm trying to show here. It's a very simple example, I should say. People could do this a lot better. This is just a bit of a labour of love of mine to try and understand whether, to a certain extent, a lot of the time when people talk about the losses are going through the roof because of climate change, actually, yes, climate change is evident, but don't get fooled necessarily by the fact that population is potentially driving this. And I know you're probably thinking, oh, here we go, climate denier in the room. Far from it. I'm just trying to understand to help our underwriters understand when they come to me saying there's this article that's saying it's in the popular press that's saying climate change has trebled hurricane losses in Florida in the last 30 years. And I'm at least be able to show them something like this. And just to end, sort of 3 overarching comments that kind of run through this. No trend in historical data doesn't mean that there's no underlying trend. It's probably just a lack of data. I'd like to lean more on the present and rather than the past for present-day risk assessment. It makes it difficult because we have a lot less historical data to be able to do that. But again, that's why I come back to the idea of trying to support historical data with climate model ensembles. And the last one is just a bit of a caveat, is be aware, don't try and conflate population-induced loss shifts with climate change loss shifts. That's me done.
Fantastic and perfect timing. Has anyone got any quick questions for Richard?
Did you understand it? That's genuinely the most important thing.
Going nodding.
Feedback.
Nodding's always good. Okay, then. I think we'll move on to the next talk. If you do get questions, Richard will be on the panel later, so we can add them in. So next, 2 microphones. Next, we've got Cameron Rye, who is going to be talking to us about present-day risk. Can you spot yours? Willis, it's pink.
Okay, so in terms of my background, so I started out in academia sort of 15 years ago doing a PhD in glaciology, and then also spent some time doing a postdoc in sort of event attribution. And then sort of the last 10 years I've been struggling or sort of enjoying the use of kind of CAT models and evaluating them and developing kind of views of risk. At the moment I work at Willis Towers Watson, evaluating models for our clients and developing our clients' sort of views of risk. So in terms of kind of my section talking more about kind of present day challenges, I think there's actually a really long list of challenges that we probably have as an industry around present day risk. But I thought I'd focus just on one, which is around variability in hazard and also in loss. These are my sort of three favorite topics around variability that I thought I'd just talk about today. So the first one is counterfactual history. So understanding how lucky or unlucky we've been in recent history and how that then impacts our quantification of risk. Natural variability, trying to understand this better and disentangle it from climate change. And then also loss amplification. So I think there's a lot of focus on perhaps on hazard and natural hazard, but also that we shouldn't forget the sort of socioeconomic factors, and that's what I'm referring to here with loss amplification, sort of post-event amplification of losses due to those factors. So the first topic is counterfactual histories. So if we look at the current generation of CAT models that are used by the insurance industry, we see that these are calibrated often to preserve the sort of frequency and severity statistics that exist in the historical record. And a really good example of this is US hurricanes. So over the last 100 years or so, we've had on average around 1.6 or 1.7 landfalls per year. Now you can pick your favorite sort of catastrophe model and pull out their expected losses or expected number of landfalls, over sort of a similar time period and see that it often matches exactly what we see in history. So the CAT model will say, on average, you should expect 1.6, 1.7 landfalls per year, and that's because it's been calibrated to history. This implicitly assumes that our history is correct and that it kind of sits in the middle of the sort of distribution for the given climatology. But we know that this is probably very unlikely that would be the case, right? Because extreme events are rare, we have this problem where just by chance or by luck, we can have some events that happen or some events that don't happen, and that has an impact on the historical record, which in turn then impacts our quantification of risk. So a good example of this is sort of a paper that I published last year looking at Miami, so counterfactual analysis for Miami, where in the last couple of years we've seen a number of storms that have come very close to making landfall in Miami, but actually it was very lucky and we didn't actually have landfall. So we had Irma in 2017, Matthew in 2016, and then Hurricane Dorian in 2019. And this just shows the sort of the hurricane strength winds from each of those storms. And you can see right bang in the middle, there's Miami, and it's not actually been affected at all by any of these events. So then, we have to ask the question, what would have happened if all three had hit Miami? How would that have changed our quantification of risk in the CAT models? So the CAT models would have been updated to account for these sort of these three storms, and that would then had an impact on our quantification of risk in the industry because we're kind of calibrating the models very tightly to historical experience. So this is a really big challenge, right? How do we understand counterfactuals, and how can we then incorporate this information into our kind of thinking on quantification of risk, and then ultimately the kind of insurance pricing as well? So there is one company that is starting to think about this problem, and that is REASC, so a CAT model company, who have very kindly allowed me to share one of their plots of showing some model output that's trying to address this challenge. So essentially what REASC have done is that they've built a tropical cyclone model, and in this case this output is showing it's being driven by the ERA 5 reanalysis, and they've taken different samples of the climatology from that reanalysis data. Sort of 2,500 different samples, which allows them to then look at counterfactual histories that could have been and see the sort of different histories for landfalls, essentially, in this case looking at the United States. And so then in this plot we've got showing the whole of the US, the box plot on the left-hand side, and then regionally as well, so the Gulf, Florida, and the East Coast. And the grey box plot represents the counterfactual histories from the REASC model for Category 3 hurricanes plus. And then also plotted on here, we've got historical observations from the IBTRAX database for different time periods, shown there by the different colored circles. So there's a lot of information here, but there's two key takeaways, right? So the first one is that the historical observations don't always sit at the sort of median of the box plots of your sort of counterfactual distribution. And we can see in some situations like the Gulf Coast, where in history we've had sort of more landfalls than the counterfactual would suggest, because the historical points are sitting above the median. And then also other situations like the East Coast, where we've got points that are sitting below sort of the median or the sort of lower quartile there, suggesting that we're being lucky. And so then the challenge is how to take this information and then incorporate that into our thinking around how we manage risk. The other point I was going to make is that if you look at history as well, the historical observations, you can see that if you select different time periods, you end up with different views of what the kind of expected number of landfalls is as well. And that just highlights the importance of or the challenge when we build CAT models calibrated on certain periods in history. You can kind of get a view of, depending on the time period that you choose in history, it can have an impact on your kind of quantification and calculation of risk. So the second point that I was going to make is around natural variability. So I think that most people here in the room would be kind of happy with the idea that the frequency and severity of natural perils varies on multi-year to multi-decadal timescales. And I've just shown an example here for some work that Willis Towers Watson have done with one of our research partners at Exeter University, looking at the impacts of the NAO on return periods of wind speeds over Europe. These two plots are showing return periods at the 1 in 10 year level, and on the left-hand side you've got an NAO positive phase, and on the right-hand side you've got the NAO negative phase. And as you'd expect, when we have a positive phase at the 1 in 10 year return period, we're seeing stronger gusts, particularly over sort of northern Europe. But this in turn alters the frequency and severity distribution of our losses as well on these sort of same timescales. And the challenge that we have is trying to understand this variability well enough to include it in CAT models, given that often as an insurance industry, we're also mainly interested in kind of the next 12 months or quantifying the present day risk. And so I think CAT model vendors have this is a particularly tough task for them, because they need to ensure that the models capture the full range of variability, or the possible variability given our current understanding of it, while also being able to provide insurers with a view of the present day risk. And so this is a plot from Stephen Cusack, who published a paper sort of on this topic last year, looking at, he essentially reconstructed European windstorm losses back to sort of 1950, 1960, using reanalysis data, and then compared it to different modes of natural variability. So in this case, he's comparing it to sort of the NAO, the Scandinavian pattern, and the Arctic oscillation. And you can see this kind of nice correlation, right? So as the modes of natural variability go up and down, your losses also go up and down. But then, so that when it comes to kind of CAT modeling, though, so the challenge is that when we think about CAT models trying to preserve historical statistics of frequency and severity, this can lead to challenges when we've got natural variability in the historical record. So in the 1980s and 1990s, there was a lot of storm activity, a lot of the losses for the insurance industry, and this in turn drove demand for CAT model vendors to kind of, or from the insurers asking CAT model vendors to kind of build these models for European windstorm to help them manage the risk better. But the problem was with the first generation of these models when they came out, they were sort of had quite a limited period of historical data that they thought was the best data at the time, going back from 1970 to sort of around 2010, that they used to calibrate their models, which also coincided with this peak in activity of natural variability. And so what happened was that the CAT models also ended up having losses that were particularly high, or sort of biased towards the high side, given the fact that they were calibrated on this period of high sort of natural variability. So this is a big challenge, right? We need to understand natural variability, or improve our understanding of it and representation of it in CAT models. I should say that since the first generation of CAT models have come out, there have been updates to CAT models to try and assist with this and provide alternative views to try and kind of better represent sort of present day activity, which has been lower than the peak in the 1980s and 1990s. So then finally, moving on to kind of climate change and natural variability, and I think this is disentangling this is a particular challenge, right? And so we need to kind of be able to distinguish or separate out, the real trends that are likely to continue and those that are apparent trends and are sort of equally likely to reverse. There are various ways which we can kind of try and answer this question, and one of them is extreme event attribution, which has already been mentioned here today. But I think there are some challenges with this, right? And I think at the moment there's a gap between academic sort of application of attribution science and sort of insurance industry applications, and for two main reasons, right? The first one is that often the attribution studies that we see published in the literature focus on hazard changes, and there are very few that actually look at kind of actual loss and damage, right? So that we do need to bridge that gap of going to loss and damage to sort of increase applications, right, in the insurance industry. And then also I think there's a framing gap. And kind of what I mean by this is that how you frame the question that you're asking has a big impact on the answer. So there've been a number of attribution papers that have looked at this in the last couple of years, where they sort of say, if you change the variables that you're looking at, or the geographic scope, or the temporal sort of length of events, like if you're looking at 3-day peak rainfall versus 2 or 1, it can have an impact on whether or not the conclusion, right, whether or not climate change has altered the likelihood of that event. And I think then when we think about industry applications, you kind of have the same problem, right? You might have an insurer that's looking at just one risk, like a bridge that they're insuring, or they might be interested in their entire portfolio or different geographic regions. And I think there's a bit of a gap between how questions are framed in sort of attribution studies that are sort of looking at the physical properties of the event versus the same questions that, say, an insurer might be asking. And the more research needs to be done around this and how questions should be framed or not framed in order to be able to address some of the questions around the role of kind of climate change and natural variability on losses. And then finally, so the third one is kind of moving away from just looking at hazard and also trying to think about some other socioeconomic factors, which are often forgotten in some of these conversations. So I thought I'd kind of throw it in there, one of them being loss amplification. So after an event has happened, often we will see, or particularly a large event, we will see that the loss is amplified, right? Beyond just a simple damage that occurs. And they're often driven by socioeconomic factors such as demand surge. So that when there's a sort of demand for sort of labor and materials, that can increase the costs. Also social inflation, which is often driven by litigation that can happen, and also political interference, which can sort of almost force insurers to pay out in certain situations to cover losses. So I think research is required to better understand this and how it varies, in particular in relation to physical parameters. So I think a really good example of this is Hurricane Irma in 2017 and also Michael in 2018. And these were both strong hurricanes that made landfall in Florida. But one of them had a very large or much larger amplification of loss afterwards, which was Irma compared to Michael. So Irma was around 50% amplification of the loss and Michael was around 20%. And it's been suggested that this is in part related to the physical properties of the storm. So in the case of Irma, the wind field or the damaging winds from the storm were very wide and covered a much larger area. And so they ended up with many small claims that accumulated and many small claims that also led to litigation, right? Around a few tiles falling off roofs and then litigation in terms of having that entire roof replaced because of the terms and conditions in the insurance policy. So because of that sort of large wind field and many small claims, it led to a lot of amplification of loss. Whereas in the case of Michael, the claims were much more concentrated over a narrow area. The damaging winds were narrower, and so we ended up seeing lower amplification of losses due to litigation, for example. So I think there's more research to understand this variability, linking it back to physical parameters of storms, and also kind of climate change and how these things, how climate change may change physical parameters of storms, which also may then also lead to changes in variability of loss amplification. So that's it. Thank you.
Thanks, Cameron. Does anyone have any quick questions for Cameron? There we go. There's one.
Hey, Karen, really interesting thought on the loss amplification and if it's linked to the physical parameters. Yeah. I think, just a point really that's maybe worth the context here is, Florida had really had a drought. So we hadn't had many tropical cyclones hitting before Irma, right? So the background situation is very different. Yeah. Michael, you'd had a big storm the previous year. So in a way, there's so many factors that go into that. But, if you think, in the absence of storms, people haven't had an opportunity to try and claim fraudulently or not, before that. So I think, once, I think they're just very different contexts, and that needs to be remembered as well. But an interesting thought to link it to physical properties as well.
Yeah, no, I totally agree. Yeah, I think it's yes, and it's. But I guess my point is about just trying to understand the variability and the different factors that contribute to that. And one of them being the lack of time or the length of time between events. Yeah.
Fantastic. And then we'll move on to the final speaker then, Tom. Tom, who wins the prize for best title of the day? Okay.
Great. Thank you, Hannah. I'm going to round out the climate carol then. So the ghost of climate yet to come. Basically, this is going to be, rather than, you've seen some great analysis from Rich and Cameron, and I'm going to round out a bit more of a narrative, I think, now for what's important for us from the industry side for the future, and try and piece together, I think, where we're at right now. And where we're at right now is just effectively post-CBES. So this was the Climate Biennial Exploratory Scenario run by the Bank of England. Involved a number of academics in this room, CGFI, and a number of industry people in this room as well who had to respond to it. After that was effectively a test that was run for 2050, an extreme scenario for multiple perils, how this is going to affect your business, and try and use effectively the CMIP models to report on what you think about frequency, intensity. I'm talking, this had a transition litigation aspect to it. I'm only talking from the physical risk perspective. It's been an amazing thing. It sparked so much meaningful discussion in the industry. At the same time, it was a very challenging exercise that don't know if the actual direct results are useful in any way other than sparking this conversation. So I want to just lay that out. There was a number of lessons that were pushed to industry in a document that was fair, but I think this is a chance for us to come back as an industry and say there's actually lessons, I think, for CGFI and for all of the academics in the room here as well. And I'm sorry, I know there's a couple of authors of the paper and a couple of quotes I'm going to put up here and correct them, but it's a really neat place for me to be able to lay this out really clearly, so it's not meant to be attacking in any way. Effectively, we had this statement first. I'm going to just say that climate risks captured in CBES scenarios are likely to create a drag on the profitability of UK banks and insurers from these results. The test was set up as a 2050, change the hazard only. You think of what Cameron and Rich have just shown, we know that we can't really make those statements, right? So, and particularly insurers, it's impossible to draw that conclusion. Effectively, how I saw the test was like it was a, what if this hazard scenario in 2050, this is really good for us thinking about how to adapt to those hazards going forward. It wasn't a test for insurers. A really big lesson, I think, though, for the academic side is that there's this unfortunate, very difficult to sort of stomach reality that property catastrophe reinsurance profitability is driven by the belief in and fear of occurrence of these events. So for well-managed insurers, the reality is greater hazard means greater profitability. So making a statement that because we've got greater hazard in the future means it's more damaging for insurers is entirely wrong. Going back to Caroline's point just now about the fact that there was a drought of hurricane events in Florida, that actually was leading to reduced profitability as a result of effectively the insurance cycle drove prices down, lower profits, and then we've just had a huge few years of activity, nearly wiped a few people out as a result. So it's not, you can't equate these increased hazard with increased loss for insurance because that's fundamentally how insurers make their money. Another statement here, projection of climate losses are uncertain. Scenario analysis is still in its infancy. I'm going to start on that statement first. It's fine. It might be in its infancy, but I could also come back to you and say, I mean, formal scenario tests have been carried out in the insurance industry for hazard since 1996. So would you say that the IPCC CMIP is almost equally infant? Maybe, I don't know, but it feels, it's just, not sure that I would agree with it. But there's another side as well that the uncertainty is a really big one here. So in this second aspect of the sentence, due to the relative immaturity of firms' approaches and complexity of the modeling, the impact of the risks, the uncertainty bands around the projected losses are very large. Don't think that's true at all. I actually think there will always be better, more complex, more sophisticated tests to do, but the reality is that it's the uncertainty that's wide because of the science that we have to deal with. There's a really great study just been shown. Adam Sobel in the US, his team showed that if you change one humidity variable in his model, you get a 30% increase in future tropical cyclone activity in 2050 or a 30% decrease. And there's no reason to choose either. So the uncertainty is that wide and we have to face it, unfortunately. So this, as I said, it's not meant to be attacking, but this allows me to set the scene for a narrative about what's really important to the insurance industry. So the aims for today shine a light on reinsurance decisions for reflection on the use of climate change data in decision chains that are real, and then refocus this climate yet to come discussion, which is why I bring the seriousness of Charles Dickens into it. But the kickoff questions then, I just want to try and answer two, and I'll try not to take very long. But effectively, two key questions for me. What time horizons do reinsurance decisions occur on? And then what types of reinsurance decisions can forward-looking climate information help? Really quickly, this is what I'm going to put forward as a proposal for us to kick off. I think there'd be people who dispute it. Cameron and Rich actually might dispute it, but we can get into that, right, on the panel. But this is my personal opinion or a loose proposal. Near term, I'm going to propose that means 1 year for us. Mid-term is 2 to 3 years, and long-term is 3 to 5 years. So this is very, very different from how the academic community would see it. That's not to say the greater than 5 years isn't important or isn't thought about at all, but they're different things. They're not clear decision chains. So greater than 5 years, social responsibility. Lots of people care about that in the insurance industry and manage to build projects for that. Client retention, potentially risk management, build back better. So paying for homes to be built better to improve vulnerability. That does happen. It's regular, it's thought about, but it's not necessarily concrete. Caroline mentioned it as well. There was something between this 5 to 30 year period that we have to deal with. But to me, that 30-year endpoint is entirely driven by regulators at the moment and investors. I don't see anybody on the inside of industry actually asking me what's my view in 2050 right now. So that's an important consideration. There are asset investments that have to be taken into account, but I'd argue they exist on the separate side of finance. And then there's an emerging risk radar and tipping point awareness, and that's a big one that I want to come back to. So for now, all I would say is that's how I would try and set it up to an academic industry, an academic community, that I would have used directly relevant for the top half and indirectly relevant for the bottom half. But just using that language is dangerous in itself, because direct versus indirect insurance has a very different meaning. And it means you've got reinsuring or direct clients. So I haven't used it, but loosely, that's what I'm trying to get at. So IPCC CMIP timelines, that was what was used to drive CBES, but ultimately they're not helpful here, right? This is obviously, everybody knows this, global temperature change, and the way that CMIP defines near, mid, and long term, even near term, is too incompatible, really, and that's the maximum time horizon that I would say gets to your direct decision chains for reinsurers. So with that in mind, what types of decisions then can forward-looking climate information theoretically help? The near term we have here, I've just put up a list, and obviously anybody can take that away and debate with me or run with it, please. I think a lot of the near term 1 year is the stuff that Cameron was actually thinking about, and what Rich was even saying as well. So it's that thinking of how do we bring in climate information about the recent, past, and present to actually get to some of these decisions. Not going to run through each of them. You can see that 1 year, I think, has some very specific decision making. It starts to get looser as you go to 2 to 3, 3 to 5. So you're almost stepping back actually from the decisions. If I look at it at a high level, you go site specific 1 year and you start stepping back to maybe global correlations. Some of the things we've already mentioned. So those are the two areas I think for reflection. Preliminary conclusions that I would then take from that is that reinsurance decisions are largely confined to less than a 5-year outlook. So I would argue seasonal to decadal information is most relevant, not IPCC CMIP. So that's something for an academic community to come to us. That's what's important to us. I think I would struggle to see how we're using CMIP. I'd love to be able to have a CMIP version of seasonal to decadal models. Obviously not necessarily, it doesn't exist yet. That's one of the biggest points I would say for any new people coming to the industry, any of the young people coming toward the industry with academic data. This is a reality that the reinsurance industry wouldn't exist without catastrophe. So it's unsound logic to equate rises in hazards with decreased profitability in this industry. Not true for nearly every other one, but risk is profit here. And I think this is where the frustration, I think, on some side of CBES was from the industry side towards the academic side, is that there's huge lessons, I think, in climate science that a lot of us are aware of and grappling with. Things like ensemble modeling, just the philosophy of why CMIP is done, how to communicate uncertainty, how to run structured and formalized sensitivity analyses that just don't really exist properly yet in CAT modeling. It's been too privatized, there's too many walls. It's that I think is valuable, but at the moment we're sort of in this, how can we use data, how can we transfer data, and I'm not sure that's where the conversation should be going. So, sorry, do I need to run? Fine. So I put some, these are some examples of how I think in the 1 to 5 year time horizon, this is present day actions on the left, and what I think climate change information could be used. And climate change information here, I'm just looking at predictive information, right? So obviously I think anything that's predictive with a dynamical model technically is climate change because it will be there. So effectively changing the peril footprint, we've had some discussions about that. I think we've had discussions about all of this, frankly. But I think these are the right way to try and go about getting data into the insurance industry and not trying to think about how do we shoehorn this 2050 and longer data into it. But final warning, I don't think we're dealing with the real problem here. I don't think we're dealing with anything. In all I've just discussed, there's always going to be debates, right? We're still having debates about present day views of risk, even without any climate information added in. This is the real reason that we're all here for climate change. Effectively, in some way, we do a reasonable-ish job at the moment of getting extreme event peril risk. Obviously, Cameron and Rich have raised some very valid points, but it's this. And I'm really glad Jason has already brought it up. And I think this is what the link in the survey actually is referring to. So that's really wonderful to see that we're on that narrative now. But this is what's missing entirely from risk modeling. And it's why climate change is a serious problem for everybody. We don't insure these events, so mass ice sheet loss, and everything else, loss of permafrost, shutdown of circulation, these things that are borderline mass mortality and extinction events, not insured, not quantified return periods as far as I can tell, and we just don't know what to do with them. So the key one though, how are they changing at different time horizons and emission scenarios? As soon as they come into what Rich said before, that 1 in 200, 1 in 250 year return period, we actually might be able to do something about it, and it might be a challenge the industry can really get towards. Final one always, I think it's been a neat day so far, but there's been decisions and decision makers been focused on, and I really like that. So yeah, it's always trying to do this with what decision and what decision maker are you trying to disrupt with the analysis you're doing. I think that's 12 minutes, so I'll stop.
Fantastic. Turns out when you send Tom an email, it says you're allowed to be provocative. He really goes for it. Has anyone got any questions for Tom before we move on to the panel? Yep.
So you went big at the end, and I got to ask this question: is the ghost you're talking about really something for someone that might not be as much in the room here? Life insurance.
I think it's for society. I think it's broader, right? It's life insurers aren't here, but I don't. When you have one of these mass mortality events, I don't know how much of the insurance industry is left, right, in current. So I don't know whether it's just a societal challenge that everybody needs to be behind and modelling across the board, as much as just saying, oh well, if we had one of these extinction events, it hits these life insurers. I definitely take the point. But I just think it's probably much more serious than that. Some of them would lead to obviously just huge loss of life, while others might lead to both, right? Property damage and loss of life. But yeah, to me, it's just that fundamental question that's missing in risk modeling now, just totally unrepresented. I don't think life insurers would be able to pick it up. I think that's the other side. So actually, I'll give you a different example. One of the really big things is we insure up to the 1 in 200, 250 year return periods. There's so many events that you can see potentially coming that are just beyond that 250. Asteroid impacts, there's some really horrific return periods associated with those. There's a Lake Geneva tsunami, which is pegged at something like 1 in 5 to 600 years. And I mean, this is like, it wipes out Geneva when it happens. These are things that, when they happen on that grand scale, I don't think our society is going to exist in the way that it does. But that's what we're trying to protect against, right? When we're thinking about climate change, I don't think it's are we getting 20 to 30% increase in the hurricane intensities? So especially knowing the uncertainty there. So yeah, it's a tough one, and I think grappling with that problem. I'm not sure where it lands and at whose feet it lands, but it's almost at everybody's, right?
Fantastic. Any final questions before we move to the panel? No? Okay, right. So can we get our academic panel members up then? Let's hope you sat in clever seats. Rowan's done it. Well done. So one of the things we wanted to get from today as well is we wanted to get some opportunity for some dialogue. You know, it's really great to hear what the challenges are, but maybe to get some feedback from some academics and the opportunity for further reflection on where do we go next, right? How do we try and solve some of these challenges? Like, is it even possible with the tools and things we've got at the moment? So let's get everyone up to, actually. You guys go too. Flank them. So let's start with the academics. Where's the other microphone? Wonderful. I'm going to give it to Len first. So just say hello, say who you are, and maybe just give some quick reflections and if anything really stood out from what you just watched that made you think, oh, you know, like what resonated with you.
Okay, so just to start, so my name's Len Shaffrey. So I'm from the National Centre for Atmospheric Science, and I'm based at the University of Reading. And my background is that I'm a climate modeller, and I'm interested in climate change and climate variability and its impacts on extreme weather. And I guess there was lots of things that came out of those talks. There's some fantastic thought-provoking statements. So I guess starting with Richard's. So yes, I mean, so some of the questions around, how do we quantify changes and losses, and how do we associate that partly to hazard, and then changes in exposures and vulnerabilities? I mean, they're really, really critical questions, right? And I guess the thing that really sprang to mind then was, you know, where's the modelling framework for us to actually address those questions? So where are the simple CAT models that we can take and actually sort of really get into the details of what causes those changes? So that was the first thing that sprang to my mind. So I guess, Cameron. So again, lots of really interesting stuff. So just to try and think through that. So where you know, I guess the similar questions, right? So around natural variability, trying to assess, changes and how far back we can go in time. I guess bringing in some of the things that Jason mentioned around data recovery. So there's lots of new data that we can pull in, but how do we use that new data to try and get a best assessment of risk, given, you know, we're going further back in time? Maybe we'll see more extreme events then, but how do we assess that with the fact that climate is changing and varying all the time? So get lots of interesting questions. Yeah, I guess so lots of exciting questions around seabeds. So I guess we'll kind of come on to that as we go along. Maybe I should stop speaking.
Thank you. So I'm Francesca Pianosi from the University of Bristol, and I am originally, I would say, a computational hydrologist, so I have some experience with flood modeling, but lately one of my areas of interest has been more generically about looking at uncertainty in models and how uncertainties propagate and how we can quantify and attribute uncertainty in model prediction. So that's maybe my angle, the angle through which I have also engaged today. And so I think there are some of the things that mostly resonate with me, and I would also like to discuss more, is this discussion of how we disentangle the contribution of the different components of the modeling chain, so hazard versus vulnerability and versus exposure. And to some extent, yes, this I kind of tend to agree that sometimes perhaps this overemphasis on hazard is misplaced if our knowledge of the exposure and vulnerability side is not sufficiently accurate, even if our hazard was changing, as you were very clearly showing, and by a huge percentage, but if still the other drivers are changing in even more, then, you know, that's a very difficult question. And then I think the other things that kind of has been underpinning all the conversations, and maybe more in the last presentation, is about the interface between the information, the knowledge generated by the model and the decision making. So not all uncertainties are equal. I suppose that if consideration of climate change or any other improvement to the modeling change leads us to change our view of risk in a direction or another. Obviously, that has a completely different impact in terms of the commercial opportunities and the decision making that follows. And somehow, I think this is probably, at least from the research side, kind of overlooked question. So is reducing uncertainty necessarily always useful in a commercial sense? I suppose that's perhaps not that's quite controversial, but I suppose I would like to explore more of that.
Thank you, Francesca. My name's Rowan Sutton. I am, like Len, also from the University of Reading in the National Centre for Atmospheric Science. Another hat I have, which I thought I'd mention because it gives some international context to some of the discussions today. The World Climate Research Programme is one of these organisations that tries to coordinate, in this case, climate research globally. The World Climate Research Programme has a 10-year strategy, and part of that, it has a set of new focus activities called lighthouse activities. I'm the co-chair of one of these, which is called Explaining and Predicting Earth System Change, which I'll say a bit more about in a moment. I found all the contributions really interesting. Just a few comments. Just a sort of factual point about CMIP. I was a little bit, you were sort of conflating, Tom, CMIP projections, what is often known as scenario MIP, with the whole of CMIP. CMIP is much broader. And in particular, there's a lot of CMIP that was focused about understanding the past, some of the issues that Rich was talking about. So it's a little bit careful not to dismiss the whole of CMIP. I think this question, and Adrian raised it earlier, this question of where we might get surprises, what's perhaps missing in all the climate models is incredibly important. And we can think of that as high impact, low likelihood scenarios, or they may just be high impact, uncertain likelihood, because in many cases we really don't know what the likelihood is. Now, the tipping points that you talked about are certainly some of those, but there may be other possibilities perhaps closer at hand. And one of the classes that I'm personally very interested in and connects with lighthouse activity is the uncertainty that we have about patterns of circulation change, particularly in the atmosphere, but also in the ocean. I'll focus on the atmosphere because the atmosphere is atmospheric circulation, large-scale patterns, the NAO that you talked about, for example, clearly very, very important for modulating hazards in all sorts of ways. The development of those hazards, how they are steered, how they vary on multi-annual to decadal timescales, for example. And I really want to emphasize how ignorant we are, actually, about the nature of variability and change in these large-scale circulation patterns. So you showed the NAO, and you described this as natural variability. We need to be very clear, we don't actually know what fraction of that historical behavior is natural variability and what may reflect aspects of the emerging signal of climate change, the sort of issues that Rich was talking about. We really don't know. There's a nice paper that some of you may have come across, Blackport and Fife last year, which looks at 70-year trends in North Atlantic atmospheric circulation and points out that the observed trends are not in any of the models. And we don't know why. So, I mean, in a way, this is a bit embarrassing for climate science because these issues have been around for a long time, but it turns out they're really tough, actually, really tough and very, very important. So, and critically important to understanding present-day risk, as you were talking about, Rich. So, I just want to highlight that really, and this lighthouse activity from the WCRP that I'm involved in. So, understanding patterns of circulation change historically and how they're changing now and how they may be changing in the future is a focus for this lighthouse activity. There are a number of, we have a number of working groups looking at different aspects of what we need to do in terms of modelling, improving resolution, larger ensembles, issues like this. There's a kind of integrating activity which is we call integrated attribution and prediction. So how do we connect our understanding of the past to what we can say about the near term? Very, very important. I mean, in fact, those of you who are in the climate science community, you'll know that the prediction activities have actually developed rather independently from research on attribution, and this is fundamentally a problem. Our confidence in what we can say about the future must be related to our confidence in how well we can explain the past. So we need to bring these things together much more closely, and that's a focus for our lighthouse activity. And then the third focus is directly about how changes in circulation, particularly on multi-annual to decadal timescales, modulate hazards, so which would connect directly here. So hopefully that kind of international context about our ignorance, it's really important to understand our ignorance. The state of that ignorance that is directly relevant to a lot of issues that are being discussed today. Thanks.
Yeah, great. Would anyone like to reflect on any of that, like the comments about is uncertainty getting smaller a good thing? Any thoughts from any of you? Or any of the other points raised?
Just one thing, Len, in terms of what's available in terms of cat models. There are obviously, Jason's already shown some work from what have you got the name of it?
Clamada.
Sorry?
Clamada?
Thank you. Yeah. And there's the LitPop database as well for exposure. So I think there are tools there to be able to, if you have a HAZ model, to be able to run it through. But again, there's always the spectra of vulnerability in there and that's something the cat modeling companies have got the wood over everyone on to a certain extent, as in they've spent 30 years looking at building vulnerability curves. So that will always be an issue to a certain extent. But there is stuff available, and whether or not someone wants to take it in, I was talking with someone offline the other day about saying we want to be able to. It'd be lovely to be able to make a open source exposure database for the that's been built in the industry, but that everyone can use, so they're able to do that. And then all it takes is someone else to do. What I did there was very, very basic. I didn't even include inflation in that, but for someone to spend some time thinking about looking backward in time and creating an open source, time evolved of exposure database, I imagine would be beneficial to all, not just in academia, but in the industry as well.
Yeah, I can confirm that would definitely be very helpful. Trying to find open exposure data sets is very difficult. So, and we've talked about the challenges, we've talked about, initial thoughts. If academia are going to help with some of these challenges, what do you need from each other as communities? So a few things have come up, interests in tipping points, seasonal to decadal prediction, and we know there are new projects about that, super high resolution climate models, but it's more than just that, right? That there needs to be the right resolution, the right kind of fields coming out of these models, the right interaction with the right stakeholders. So to start with the academics, like what do you need from I don't even know what that was. Hailstorm, yeah. Measure it, data. We'll start with the academics. What do you need from the insurers? And then we'll go insurers. What do you really need? Because you've mentioned broadly, but how can we get into more depth there?
Just one thing that came up. You brought it up, Rich. Is this on? I don't know. And it came up this morning. There were requests for kind of more ensembles, and it would just be helpful to hear what sort of ensembles you actually think would be useful. Again, as many people will know, CMIT produces lots of ensembles, and there's been a lot of growth in large ensembles of one sort or another. There are many, many choices that need to be made. From an international perspective, CMIP 7 is in the process of being designed, and there's an opportunity to shape that. And if aspects of that can be shaped by particular industry requirements, that would be great. There are also activities like Destination Earth that the EU is investing in heavily, producing particular sorts of data sets that it is hoped will be useful. Whether how useful they will be interesting. So it'd just be helpful to hear what sort of ensembles in general you think might be helpful.
Can I have a go? Sorry, yeah, I just want to. So, in some sense, I almost want to take a step back even further, right? The cat modeling industry doesn't have any standards yet. It's really difficult to deal with that. So, anybody doing evaluation, Rich does a lot, I do a lot. I think we probably have a lot of similar ideas, but there'd be no standard between us because we can't see how we're done. And I think, in some sense, a lot of the model providers at the moment get away with a lot because they have no standard to hold themselves to. And frankly, it's probably we're not the experts on the hazard side of the ensemble producing to say we need this ensemble because we get this information. So it would almost be I suppose it isn't just an easy, we need it from you. It is a conversation, a dialogue, but if you're going to build a tropical cyclone stochastic set, and you need fundamental frequency intensity distributions, you need footprints at the highest resolution you can. At what point do you draw the line under this is the level of information that can actually be gleaned from these types of ensembles, and you shouldn't try to pretend that it exists. So there's so much there that I think there's a lot of assumptions about the CAT models that they work well at site level. They don't work well at site level. They're made to be aggregated because that's what an insurance portfolio is. But a lot of people in the industry don't necessarily understand that on the ground. And so I think it's going to take a long time, but a conversation about, okay, we've produced a large ensemble and multiple, but you can't go further than this for understanding, so it might be a spatial resolution issue, or just we know that there's limitations with how this footprint is represented, and therefore this type of damage won't come through. Having those very transparent and laid out from the academic side would be hugely valuable for us trying to push the standards. Yeah.
You've lost where you all are. Right. So, what do you need from each other to start to work on some of these challenges?
I mean, I can say a few points. So, as someone who kind of uses CAT models and uses sort of research output to adjust CAT models, I think there's dialogue required around kind of the sort of, I guess, the outputs from academic models, right, and how they can be used. Because if you think about a CAT model, often we're working with a very small number of parameters, right? We might just have like a big table with frequency and severity of losses in it, or we might have some information about hazard, but it might be like just a single parameter, such as 3-second peak gust or something like that. So I think like an example is that, a few years ago, I was working on a project with some academics around storm severity in Europe, and there's like 3 different ways in which you can calculate storm severity index. And I think the data that we ended up getting was calculated in one way, and it was different to what it was calculated in the CAT model, and so that limits the kind of usability of it. So there's more, given kind of the IP constraints of CAT models, we still need to be able to kind of talk about what it is that we kind of need to be able to make adjustments to CAT models or validate and review CAT models. Yeah.
So I guess as well as just kind of the outputs from the climate models and how they feed into CAT models, and is there a need for more guidance on how to use the climate model information? Because I mean we've sort of come up again and again with the question of evaluating the climate models and what they're good for, and not being too stuck in the model world and trying to say something about the real world.
I mean, it depends, right? There's different levels of capabilities across the insurance industry, and I certainly think there is certainly the need for guidance of the use, and also, when you shouldn't be using climate model outputs for certain things, right? Yeah, definitely.
I think just going along with that is I've seen a lot of ensemble climate model output. That's in fact the stuff that we're using, where it goes 1950 to 2010. Then 2050 to 2100, and I think, I'd love it if it just went 1950 to 2025, just so that we've got the delta between past and now, rather than delta between the past and kind of 10 years ago-ish.
Yeah, I guess that's kind of a key point, isn't it? A lot of academic papers you see are focused on the past or on climate change. Do you struggle to find things then on the time period that you are particularly interested in? And I guess academics, why aren't we writing papers about that? Is it just because we like to see a nice difference plot with the climate change signal, or,
Just a sort of slightly boring technical dimension of that, but it's relevant, is that with CMIP, historical forcings are reconstructed. So obviously we think about the greenhouse gas concentrations, but there's a whole bunch of additional forcings that have to go into these historical simulations. Changes in ozone, changes in land use, for example, changes in aerosols. And they have traditionally been done up to a certain date, and then beyond that there's some kind of scenario. There is effort, emerging plans as part of CMIP 7 to try and at least bring up these historical reconstructions up to near real time, which would be really helpful. of course, as soon as you go into the future, you have to make assumptions about scenarios. And actually, there was a comment. Was it Claire this morning? Said that she didn't like the CMIP scenarios. So it'd be good to hear what sort of scenarios would perhaps be more useful.
Yeah, great. So I'm just going to open this up. Does anyone have any questions for either our academics or insurers? Yep. Marie. So while we're getting there, I have a quick question for Francesca. So Richard's done in his slides, he did his uncertainty analysis, breaking out the components. This is something you have worked with insurers to do, right? Like, how was that process? Is this something that we could put on mass scale? Because it sounds like it's something that's very important, right? And that Richard and others are clearly trying to do.
Yeah, as I said, I really appreciated that work, and also I think Tom, you mentioned it in your presentation as well, that perhaps the emphasis should be shift from, if I get it right, we need this specific data product, we need this specific piece of information, to perhaps more methodological questions of how do we do things consistently. And I picked in particular, you mentioned it, structured sensitivity analysis. So having structured approaches to analyze certain questions, such as, for example, where are the main contributors to the final uncertainty of losses, structured approaches to decide where investment should be made into improving which model component, which data set, because that makes the most difference. So we have tried to do some of this work. I think perhaps the two main barriers, I think, to uptake of some of these methodologies that are available quite and quite commonly used in scientific research, in transferring them to insurance industry, have been number one, the lack of transparency of a lot of the models that are being used, and the fact that often users are not actually able to fully access the model, which doesn't mean necessarily the source code of a CAT model, but the ability to change and perturb the input of a model in a consistent way. And in that sense, I think things are moving and changing quite a lot in the industry. And then the other one is perhaps the computational power issue, which I think is, a lot of the analyses are perceived as too complex to be affordable. And so perhaps again, the ability to learn a bit more and share a bit more from across different projects. And I mean, this is obviously quite an issue in insurance, but I think these are, I think, have been the two main barriers we confronted with.
Right, okay. So I think when presented with a large ensemble, I think someone else said that all models are sort of have different capabilities, and doing model verification is quite a comprehensive task that's often outside the remit, sort of time remit of certainly, I think, brokers and insurance companies. So comprehensive sort of model verifications, looking at how well do they capture sort of large teleconnection patterns or large scale modes of variability to get a better feel for if we have to sub-select. I mean, that's often done. Could we at least make sure that we sub-select a range of different model families that do things in different ways, so we capture the spread of variability, but that information about how different models perform differently well for the different parts of the world where these large-scale modes have much larger influence than in Europe. So being able to spread that, so if we sample the space appropriately, that would be really useful to sort of guide the users of how you kind of sub-sample within models. And interpretation-wise, like, should you put confidence in this at all, or is it meaningful to use this data?
Great. Anyone want to comment? on that?
Yeah, I'd fully agree that trying to understand how well the climate models represent large-scale teleconnections is pretty critical. I think we've seen lots of examples of that today in the various talks about how important that is for thinking about risk and modulating risk, thinking about modes of natural variability. And thinking about how we most optimally use large ensembles and multimodal large ensembles to capture the range of variabilities that we think are important for modulating that risk, I think is an essential thing to do. I think I'd fully agree with that.
Thanks. Yeah, complete agreement as well. And I suppose one of the things that's actually quite easy from our side is, and Cameron and Richard both showed it, it's actually easy for us to actually put narratives around the historical observational data that drive different views of stochastic sets. So some of the things that we do, Rich and Cameron probably do as well, but just subsampling a stochastic set to try and see what the AMO might be if you just looked at that in a positive phase or negative phase, or non-oscillation thing, and you looked at sulfate emissions, or you just looked at decadal climate states and everything. We do that, and I think actually insurers at the moment are actually quite receptive to it and hearing about it and hearing about the relative uncertainties between them. To your exact point, I think it'd be really wonderful if we could find that same way to link that narrative for some of the modeling studies that maybe go out towards those 0 to 5 year dates and start actually structuring narratives that can be continuous into the future as opposed to just being historically driven.
Fantastic. Yeah, Rowan? Oh, David.
Got a few points. You stimulated me in a few ways. So, one point, I suppose, with the teleconnections is not just whether the models are actually representing certain modes, but also whether they're getting the connection with the hazard. So what we've been seeing in Exeter is some of the models will get NEO, but their NEO isn't connected to their storms for some reason. So that is something that they'd look okay as a climate for NEO, but the other one with NEO is there's a big elephant in the room, which is basically climate models underestimate the NEO signal. We know that on seasonal timescales. There's a signal-to-noise paradox, and there's a question it's missing NEO variability on decadal timescales. That seems to be the case with climate models. So there's a big question about what's going on with NEO in the models, and that affects the climate change projections for hazards like floods and windstorm over Europe, definitely. So that's one that could change completely if NEO starts getting bigger. So we know it's certainly missing that in on the shorter, nearer term timescale. So that's something we don't know the answer to, like Rome was saying. Final point, I get very confused when people talk about return periods for tipping points, because as far as I understand it, if you had a tipping point, it might just be one thing. So I don't see it like a stochastic process. It's more like bang, it happens. So the concept of return period, I wouldn't be able to have a stochastic event set of its tipping points. I'd only have one of them, right? So maybe the whole framework of return period doesn't really work with tipping points. So that's something that probably needs to... You could talk about a probability of it occurring in a certain time period, but it's not really a rate of a process, that's for sure. So those are my 3 bits.
Wonderful. Who wants to comment on the NAO?
Maybe Tom can comment on tipping points. Obviously, I agree totally. And yeah, you mentioned the signal to noise issue, which is just sort of an elaboration that there is, there is very intriguing evidence that actually models may systematically underestimate this atmospheric circulation response to certain drivers, which is quite worrying, actually. And we don't understand it. There are some hypotheses around. Just to further comment, though, this isn't just about the NAO. There are many other large-scale patterns of circulation change, not just in winter, but in other seasons that we don't properly understand. And of course, another aspect of their importance is, which may become increasingly important, is the whole issue of spatially correlated risks, potentially between different continents and so forth, which circulation patterns bring in and could be very poorly understood at the moment and potentially becoming more important.
Yeah, you're completely right on the return periods things. I as long as it's a probability of occurrence, that's fine. It's just we'd need that number, right? If we can't put something on as a return period or probability of occurrence or exceedance of occurrence, we can't do anything with it. Yep. But I guess that's the challenge, right? If we can't put a number on that, we can do nothing with it. Yeah.
I mean, just to push back on that, and maybe that's a large discussion. I mean, this whole question, I'm sure Jason might like to comment on this. This whole issue of how to deal with high impact, low likelihood risks is challenging for everyone, and I think we don't have the tools to do it. And actually saying we need to quantify this risk, I think that may be too restrictive, because there may be lots of really important risks that actually we just can't put. But that doesn't mean we should ignore them. It means that we have to think about what else we might do. Richard Wood at the Met Office led quite a nice paper, which I was a co-author on, which has just come out actually, which you might like to look at, about sort of different ways of thinking about high impact, low likelihood risks and how to manage them. I don't know if you want to add anything, Jason.
Yeah, I mean, I guess on the likelihood side, I'm not quite as pessimistic. I think it'll be a long time before we can get a precise distribution, but I think sometimes there are lines of evidence that tell us something about where a particular type of tipping point might be. I think we do understand more about the processes in many cases than we did before. So I think that's true. For instance, if we look at West Antarctic ice sheet collapse, for instance. But I think how we use that information, the paper that you and Richard were involved in, I think one of the ideas from that is focusing on early warning. And I'm curious to think how insurance might pick up that knowledge of different early warning timescales, because it certainly potentially changes how the risk manifests. So maybe that's an interesting avenue to explore.
Yeah, absolutely. That links quite nicely to my final question, actually, before we pass over to Christoph. So just to the academics, is there, and maybe anyone else in the room if you want to put your hand up, but is there anything that's come from the insurance side? Well, is there anything that hasn't been talked about today where you it surprised you that it's not an issue? Because I think sometimes as academics, we're quite good at putting words in the mouths of the users, right, of what we think they are most interested in. Is there anything you're surprised not to have been mentioned, or do you think generally we're starting to be on the same page? And if anyone else wanted to comment.
I mean, just a very quick comment on convergence. I mean, Tom, you didn't actually comment on Rich's talk, and I was, I've basically agreed with everything Rich has been saying for years, for a long time. I mean, I think this question of what is the current risk shines a light on an awful lot of things, and the climate change signal is a key part of that. I sort of assume you kind of agree with that, but you didn't actually comment on that in your talk, so maybe you'd just like to, because if we have convergence about that, that's a helpful thing to agree.
We do to a limit, but it comes back to Francesca's point. I think that we haven't yet tested the models to see what the uncertainty and the things in the exposure things when we project that forward. If we know the population dominates so much as it is, I'm pretty sure I could do a 5-year projection of what population is going to look like that's going to be more confident than a climate one. I don't see anybody doing that. It's really crazy. So I completely agree that the climate signal for virtually all the perils feels significant and unignorable. But there's so many other things there that that methodological piece that Francesca picked up, I'd love to be able to unpick that and find out where we should be driving everything together.
Hey, thanks. Just a couple of points, and I don't suppose they're completely unsaid here, but at a point, I don't think anyone's really talked about using the strengths of the respective industries. I mean, we talked about, having open access exposure data or access to, vulnerability functions. The CAT modeling vendors have this. Do we really need to reinvent the wheel here? Of course, there's one end member who can't share everything, but there's a whole host of other conversations that I think could be had in between that. And I think I just sort of encourage academia, if you have ideas and, if your aim is to publish a paper or as a specific study at a conference, approach us and see how we could potentially leverage some of our vulnerability functions or leverage our exposure data. We have software solutions that allow other sort of views of hazard, other models to be brought in, and that could be combined in, sort of exploratory studies or academic, towards a paper that could be used. So please don't assume that because it's proprietary data, that there's not a whole spectrum of conversations that can be had on there, and sort of think about not reinventing that wheel. So that was my first one. And I think the other one, similar to what Cameron was mentioning about sort of metrics that are useful for adjusting models. I think event definition has to be a really important conversation here between academia and industry as well. Very much, we build CAP models on a meteorological base. That's not even how the industry considers these things. There's hours clauses in there. So for information, I think, from the academic industry to be useful for these adjustments, we need to have that discussion around sort of event definition and hours clauses. Thank you.
Thanks, Caroline. I like the positive note that we can ask you for things. Anyone want to comment? Or if not, we'll go to Jason.
It's an old chestnut, but in academia we have to publish, and the pressure for the requirements around open data and open source code have become more and more important for good reasons. So this is a real barrier. We can't ignore it. I don't have a solution unless the CAP model industry wants to go open source. Wouldn't that be nice?
Oh, can you imagine? That'd be a funny day. Right, Jason, would you like the final word?
So, things that have not been talked about. There were two things that stood out. One specific one and one slightly more general one. The specific one, when we're thinking about adaptation, increasingly we're talking about really complex risk types, and in particular, cascading hazards and cascading risks. And I guess the equivalent of that is really sort of blowing up the vulnerability function in this case. How important is it within your sector to think about both cascading hazard and cascading risk? My general point is I wonder if we're slightly asking the wrong question or too limited a question when we ask what could we do together now? Because when we think of the long development times in some of the aspects of climate science, so time cycle of a CMIP is 7-8 years. The time scale to develop a new climate model is not dissimilar. So I'd also be interested in a view of what will you need 10 years from now, because I think that's something really valuable we can work towards.
Just on the comment of the planning stage of something in 10 years' time, the only thing that I'd ever want to say to an academic that is planning a project is just include us in the planning phase so that we can. I've had a situation where I've spoken to people about, do you have the integrated peak gust, as in the peak gust in the last 6 hours? There's no, we've got the wind every 6 hours, but not the integrated peak gust. I wish I would have been in that planning committee at the time and such. Integrated peak gust, please. Just make sure that, not make sure that, but it'd be lovely to have at least a seat at the table to be able to voice things when these type of things are being planned, because there's things that can easily get missed that are probably very, very straightforward to do when the models are churning out numbers.
Yeah, about what perhaps I would have thought would be discussed more is perhaps also the more broadly, and again thinking about the where things will be in 10 years from now rather than next year. Cascading and compounding event, as well as perhaps the effect of climate on exposure and the interactions between the three components. For example, simply how people will move and where a new market potentially and new needs will emerge for insurance. So not just projecting the status quo, but where new also opportunities from the point of view of insurers might arise. I thought somehow, I would have thought this might come up.
I guess one area that maybe we could discuss more about would be kind of we've talked about thinking on kind of seasonal to decadal timescales, and that's been very important for the insurance industry. And I guess given that, thinking about NAO forecasts and the recent development of skill in those forecasts, whether those sorts of things might be useful at some point. And I guess the key question there is, what level of skill would you need in an NAO forecast for you to actually find that useful? So at what point would you go from these are difficult to use to something that actually we could make money out of this?
On that, there's just a crossover between forecast skill and how we align our seasons. So most of the reinsurance contracts are written in May and June for the forthcoming hurricane season. But for the Japan typhoon season, they're all done in sort of 1st of April, where you've got the spring predictability barrier for El Nino. So a lot of it actually is, I would love to be able to sit down with the insurance industry and just say, can we maybe realign our renewal season so that we can actually benefit a bit more from forecasting information rather than not have them 6 months before the peak risk happens?
I'll just add one bit to that, though, and it's sort of to David's point, right, that there's this mismatch between when you're talking about NAO forecasts and really I'm talking about stingjet landfalls, right, and that's it. And I suppose until you can really give us that information with some, the other side is that it doesn't have to be really accurate, it doesn't have to be a level of skill that was like, okay, we've made that decision now. I actually think it can come with massive uncertainty bands. So I hope that and that I think also leads to this probability of occurrence thing for tipping points, which I think is a lot more optimistic than it might seem at first. But yeah, as long as it's bounded, then it can be used. But it has to be these, landfall of the storms, not the NAO, right? And get frustrated hearing the hurricane forecasts, predictions come every year, and it's just basin-wide activity, and it's like, well, it's still meaningless, right? I mean, nobody can use this, and RIASC are doing a great job actually of pushing forward. Well, can we get landfall prediction out of this? And there's others doing it too, but it's a really slow process. And most of the time, I find that a lot of the academic community hide behind, well, we can't do that, and we've got skill when we do basin, so I'm just going to keep doing that. And I said, well, okay, well, you're trying to solve a problem, aren't you? This is not a blue sky issue. If it was a blue sky thing, you can forgive it, but it's not. You're doing seasonal hurricane prediction, so you should be doing landfall. So yeah, it's trying to make sure you've always got that in mind. Yeah.
Fantastic. Any last comments from Cameron?
I was going to make a comment about it's like predicting the next 10 years, or not, well, just thinking about things that are important in 10 years' time. I think often when you see when an event actually happens, there's lots of things that aren't in models, and then we go away and we research them, right? So I think the challenge is about trying to identify things that are missing from models, or trying to identify those challenges before they happen, the gross ones, and then researching those and trying to quantify them. Yeah.
If you want to send us all the list, that's right.
Yeah, Jason would like a Christmas list of. Okay, well, I think we should wrap it up there. So can we all please thank our panels and speakers for a really great section. And pass off to Christoph for the final words.
Final words. Yes, I think there was an awful lot of food for discussion. As with many of these events, there's more questions raised than answers received. But I guess we are academics after all. So I think, yeah, there's so much to be taken away from this. There's so much, I think, that we should continue talking about. This is not the start of a conversation. It's an ongoing conversation that RMetS have started with their special interest group for insurance. So this is great. I think the next step, the roundtables that will be organized in the autumn, will give us another chance to dive into some of these topics in even more detail. At the CGFI side, we are very keen to not only, let's say, to expand this discussion actually outside of the insurance community and see what can we bring to other parts of the financial system. How can we bring to bear the capabilities we have in insurance, in academia, across these different timescale, on the different models, on incorporating physical climate risk, how to drive adaptation, price those in banking, asset management, asset ownership, etc. So there's so much more that we can be doing and should be doing to really drive, incorporation of these issues in finance and green the financial system in that way. So we're very much hoping to see you all again in our future events and keep engaging with us and with RMetS as well. Some other, I guess, final things quickly to mention in terms of events other than the roundtable from RMetS is we have our annual forum at CGFI in 2 months' time. Also in London, where we'll be talking about a range of issues linked to data and analytics for green finance. We'll be talking about transition plans, talking about stress testing and CBES. We may or may not invite Tom to give his views on these. But they're duly noted. We'll be talking about nature-related risks and opportunities, and also physical climate risks and compound hazards. So do come along. It's a broader community, but again, I think we need to have some of these discussions across different parts of the system as well. And that just leaves me, other than mentioning, in case you haven't heard about it yet, there is a survey on Philp that may or may not be interesting for filling in. And finally, I just really want to thank a couple of people who've made this event a reality. So thank you first and foremost to all our speakers and chairs of the session. So maybe another round of applause. Thanks also to particular Alex and Yilka, who are all the way in the back, though they should be at the front. They've really been organizing this event, taking care of nearly everything. So thanks so much, Alex and Yilka. And finally, one big thank you for Hannah, who's really kind of the driving force in bringing together these different communities, who does everything she can to build or bridge that gap, translate and be that connection across RMetS, across CGFI, working closely with insurance. She's absolutely fantastic. And this event wouldn't have been possible without her. She asked me not to mention that it's her birthday, so I won't. She did ask me to sing a song. I could sing Happy Birthday, but also that I won't. So just one more final round of applause for Hannah. And then hereby, the event is kind of the formal proceedings are finished. Let's keep talking over a drink just next door, and we're looking forward to seeing you in the future. Thank you.